Should you pay off your debts first before investing? Many of us have been asked this question at some point in our lives. Why would you choose to pay off debt when you could invest it and earn more money than what the loan is costing you? Is it better to invest surplus cash so that it grows and creates exponential returns in the future? Or is it better to use it to pay off or at least minimize debt? The fact is that any alternative is viable, but you may be surprised by the difference that one small decision will make. In certain cases, actions taken now might mean the difference between hundreds of thousands or even millions of dollars in the future. Hello everyone and welcome to Wealthy Wisdom. In this video, we're going to talk about which comes first, investing versus paying off debt. If you are new to this channel, do like and subscribe to the channel. Before determining whether to invest or pay off debt, be sure you have a stable financial foundation. This simply means putting money aside in an emergency fund that is exclusively utilized for unexpected expenses. Paying off debt or investing is pointless if you don't have money set aside in case of a financial crisis, since a single financial calamity may bring you back to square one. If you don't have any cash in hand and your car requires major repairs, you'll have to sell assets or go into debt to pay for it. Before moving on, you should try to save enough money for 3 to 6 months of expenses. The extra room in your budget you'll have when separate debt payments are taken out of your account is possibly the most appealing feature of paying off debt and being debt-free. Self-employment may be difficult. The more debts you have, the more probable it is that you are living paycheck to paycheck and barely making ends meet. When this happens, it seems as though you are just going to work to pay your bills and not to advance your money. Even though your loan debt is steadily diminishing, a large portion of your payments are going to the lender as interest. When you have paid off all of your bills, you will feel as if you have received a substantial raise since you will be retaining a lot more of your money. When you don't have any debt, it's much easier to put more money into your retirement account, which could let you retire sooner. Many individuals elect to invest their extra cash instead of paying off all of their debts. The reason for this is because they may earn big profits since the return on their assets may be much more than the interest on their commitments. Is it really worth it to pay off debt at 5% interest when you might earn 10% or more on investments? When deciding whether to quickly decrease debt or invest additional cash, risk is the most important factor to consider. Waiting too long to invest may cost you a lot of compound interest, which would grow your wealth over time. When you pay off debt, you essentially earn a guaranteed return. If you pay off a loan with an interest rate of 30% from a credit card company, you will have made 30% without taking any risks. If you like this video, don't forget to like and subscribe to the channel. Investing always carries some level of risk. Is it possible to invest in the S&P 500 and expect a return of at least 10%? According to Investopedia, the S&P 500 has gained by an average of more than 10% every year since its inception. However, the market has sometimes yielded negative returns. For example, in 2000, it returned a negative 10% followed by a negative 13% in 2001 and a negative 23% in 2002. Following that, it had a few years of prosperity until 2008, when it returned a negative 38%. The potential for making a profit in the long term is high, but returns are not guaranteed, so keep this in mind as you implement your financial plan. Consider the clear real-world contrast of investing versus paying off debt. Assume you had a $370,000 mortgage with a 30-year term. Every month, you will pay a low interest rate of 5.13% or $2,016. You have an extra $1,000 in your budget that you want to use to pay down your mortgage or invest in, and you make a decent wage at work. You're not sure which is more likely to enhance your circumstances at the end of the 30-year loan term. Scenario 1 involves paying off the mortgage. Instead of letting that mortgage linger for 3 decades, by paying an extra $1,000 per month in principal payments, you might be debt-free in 15 years. This means that you will only pay $172,880 in interest over the life of the loan, and you will contribute $3,016 per month in addition to the $1,000 monthly investment. A 30-year investment of $3,016 every month will yield a total of $1,211,290. After subtracting the money you have already invested from the $172,880 in interest paid, you will have a total of $1,038,410 at the end of the 30-year period. This computation simply takes your entire cumulative sum and subtracts the interest you paid. The second option involves investing after paying just the minimal minimum. If you invested your extra $1,000 each month in addition to making the minimum mortgage payment, you would wind up paying a whopping $355,760 in interest over the duration of the 30-year term of the mortgage. By investing $1,000 every month in the SP 500 and assuming its 10% annual return, the investment will have grown to $2,079,293. This is much higher than in the first case. Your total investment of $2,079,293 minus interest of $355,760 is $1,723,533. There is a $685,123 discrepancy between the total and Scenario 2 and the total and Scenario 1. This implies that if you invested your additional $1,000 per month into the SP 500, instead of paying down your mortgage, you'd have more than $685,123 at the end of 30 years. That amount might be the difference between being able to retire and having to work for many more years. Of course, this assumes a reasonable average return over a long period of time and overlooks the dangers of stock market trading. One of the primary factors working in your favor with a 30-year mortgage is inflation. The mortgage payment will always be the same dollar amount for the length of the loan, but the dollar's value will decline with time. This means you might repay your obligation with money that is now worth less than it was before. If inflation averaged 4%, the dollar will restore its worth once every 18 years. Simply put, your mortgage payment is half of what it was when you took up the loan 18 years ago. You may invest in assets with dollars that are less valuable than they were before, giving you the best of both worlds. When deciding to investing versus paying off debt, a mortgage is a more serious scenario for two reasons. The first is that a mortgage is often a very low interest loan, possibly the lowest available, with an average mortgage rate of 4% to 4% in 2022. As a consequence, since the interest rate is so close to the inflation rate, you are borrowing more money for essentially nothing. As a consequence, some investors choose mortgages. The second is that mortgages are long-term loans with a 30-year average maturity. With such a long loan term, the choice to invest additional cash or pay off the debt is much more essential and should be carefully weighed. When deciding whether or not to pay off debt, it's not as straightforward as one may imagine. So there are a few things to consider. Cash flow is undeniably a substantial benefit that may free up your budget, which is critical for older individuals planning for retirement. Your major concern should be cash flow, not which approach will provide the highest return in 30 years. Risk must be considered while developing a strategy. and this must be recognized. In general, using low-interest loans and repaying high-interest loans will provide the most long-term advantage. You might want to do both by using extra money to invest and slowly pay off debt. You should also consider doing both, using extra money to create investments while gradually paying off debt. People have strong feelings about this issue. To choose which course of action is best for you, you must consider the risks and benefits. Each circumstance is accurately represented by the figures. Consider the benefits and drawbacks of each option. We've reached the end of another video and thank you for watching. I hope that we helped you decide between investing versus paying off debt. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye!